All right, let's keep talking some earnings and big moves from this week. Monster sell-off in Domino's Pizza deserves a second look. We're going to start there with Nick Setyan from Wedbush. Tom in studio, getting ready to look at the options as well. Nick, great to have you back here. So Domino's, like pretty rough response. So what did you think about the actual earnings, and is it appropriate, the sell-off?
Hey, well, first, thanks for having me. I think, the jitters are understandable, but I do think the sell-off was a little too much and unwarranted. The company hasn't changed anything that they're saying, especially in terms of the domestic business. I think the expectations had run a little ahead of themselves to maybe, justify the run-up in the share price. Consensus numbers kept going higher, especially for the second half. But at the end of the day, second half commentary is pretty much in line with the full year guidance. So it was just a game of, expectations at the end of the day. And they are being conservative, right? I mean, for the second half, they're being conservative for prudently so, especially with what's going on with McDonald's and the $5 meal and the incremental aggressiveness around the competitive environment. So I do think it's right for them to be conservative. I do think they have the drivers to be at least in line for the second half.
What about falling pretty well short of the expansion plans that they had already laid out? What does that tell you? Is it not making sense for them to open up new stores? Did they just overestimate? Can they blame the economy or what?
The whole shortfall with the stores and it was basically international, mainly Japan and France. The more than 50% of their growth is really concentrated in China and India. And so Japan and France, they're mature markets. That particular master franchisee overbuilt a little bit. Now they're right-sizing those markets. So it's really just a short-term issue that has to be right-sized. And by the end of this year, I think they'll have better visibility in terms of the actual number of, openings internationally, and they'll give us the guidance again. And then two, it's four to 5 units internationally equates to like one, unit domestically. So especially on a margin, it's just not much of an impact.
You lowered your price target, still significantly above where we're trading though. To the point about the international expansion, their comps internationally 2%, comps at home closer to 5%. I guess part of me is not surprised that the internationals are not as impressed by Domino's, but what's the story there?
Well, in fact, the international comp was, 2% above consensus, right? So the international market improvement outside of those two markets in particular, including in Europe, is actually ahead of expectations. So we're seeing international markets come back a little bit faster than we originally thought. Second half, I think international is going to be probably ahead of expectations as well. I think most people are going to keep their numbers around 3%. So even at 3%, it's an improvement. The bottom line is international, X those two markets is actually performing ahead of expectations.
Okay. Lastly, for Domino's, as it compares to the peer group, overall top-line sales growing 7%. It seems pretty solid, and with the domestic comps at roughly 5%, how does that kind of rank in your coverage?
It's one of my favorite names. It's on our best ideas list, frankly, it's one of the only names that has visibility into driving positive transactions over the next 2-3 years, and we certainly have the drivers for that. Even names like Chipotle don't necessarily have visibility around, the next 2-3 years of positive transactions. So, Domino's is at the top of my list, and I think this pullback is a very good, opportune time to get into the shares.
Got it. All right. Hang with us because we got some Tex-Mex to talk about in a second. Tom, looking at the options here for Domino's, how did the market respond? How did the options pricing respond with this big drop?
Well, the event risk has gone right post-earnings, but implied volatility level still stayed relatively firm despite that. The pullback below its 200-day moving average, hitting lows that we haven't seen since January, maybe that opportunity. So I looked at a strategy that gives me a little bit of duration using the option market. It's a high-price stock. Wide bid-ask spread, so price discovery warranted on a lot of these strategies that you're doing in Domino's with the small share float that's out there. But I looked at an August 30th weekly option series. So you got about 42 days till expiration on this one, where I'm going to buy an unbalanced or skewed call butterfly to the upside to offset some costs on the bullish part of this trade. So going out to that August 30th weekly strategy series, buy one of the 410 strike calls. That's right at the money. Sell two of the 440 strike calls, and then buy one of the 450 strike calls. So you can see it's unbalanced where you're buying bullish $30 wide call vertical within this strategy, and then selling a $10 wide one to offset some of the costs. You're paying roughly about a $9 debit. It's probably trading closer to $10 now. But if you pay a $9 debit, there's your risk, $900 per spread. Takes your break even up to $4.19 over the next 42 days. That's only about 3%, a little less than 3% above the current share price. Now, the apex of profitability is right at that short strike at the 440 line, but even above 450, it's more than a double on this. So this might be the way to play it, where you can offset some costs, but still taking that bullish stance on the stock over the next month and a half.
Okay, all right. So a bullish approach there, a little dip buying, and directional, very much so. So you want it to rally, you want it to come back. I don't know. So far, it's not exactly springing back.
No.
It's flattened a little bit here. I'm trying to come up with a pizza pun, but I can't do it. Nick, let's talk some Tex-Mex instead. This Darden deal with Chuy, kind of interesting. Shares haven't loved it so much, but what about the strategy? Does it make sense?
Yeah, I mean, to me, like, it's a differentiated brand. It's something that they didn't have. Now they do. It's basically neutral to near-term EPS. It will be accretive, over the next couple of years. So, I mean, it'll add about a percentage or so to the EPS growth starting in 2027. So not a huge deal. It's not going to change the needle one way or the other too much as far as Darden is concerned. But so it's just a nice to have, for Darden. But as far as, the rest of, restaurants, obviously this is a great thing in the sense that a lot of these casual diners, the company-owned models, are trading at valuations that are very attractive. And if Chuy's can get bought, I think there's an opportunity for a couple other names like a BGRI to get bought as well and taken out.
Buy Darden, or just generally consolidation in the industry?
Either Darden or a strategic or non-strategic acquisition as well. Maybe private equity. I think the issues make sense.
Okay. I've never had Chuy's. Is it good?
It's very good.
Yeah,
very,
looking at the
good.
pictures, it looks pretty good. Real kind of soupy enchilada. I don't know how I missed that one.
Great.
Where are they mostly? Like, what's the regional exposure?
Well, Texas is where the brand equity is the highest. Austin's where they started from. So largely southeast.
Got it. All right, Nick, great stuff. Always appreciate your thoughts.
Thank you.
Nick Setyan, Wedbush. All right, you got a trade on Darden here, Tom? Chuy's looks good, man. I need to check this place out.
Yeah, I mean, can it compete with, what are the other ones? Moe's and then Chipotle, of course, which is more fast casual.
This is like enchiladas and stuff.
Okay. Well, we live in Chicago, Oliver. We got some of the best Mexican food in the
Yeah, but it's
country.
different out of here. When you're West Coast born, you crave West Coast Mexican food.
Oh, boy, I don't even know if that's edible. But let's look at Darden. Shares down about 13%. So far this year, off about 5% so just this month alone. I went a little bit more conservative with this strategy based on the fact that this pays a 3.9% dividend yield. So how do you take advantage of that and create some yield if you want to own the shares as it's underperforming? So I looked at a covered call strategy where for every 100 shares of stock that I buy, I'm going to sell an out-of-the-money call to the upside. I went out to the August 16th monthly option, so 28 days till expiration. And for every 100 shares of stock you buy, you sell one of the August 145 strike calls, just out of the money to the upside, paying roughly about $140 debit. So you're buying the shares, you're buying them at a discount because of that option premium that you're selling on the 145 strike. Break even's 140, the debit you pay on this one over the next month. That's only, you've got a cushion of over 1% to the downside. So you're buying the shares at a discount. You get the yield from the dividend that gets paid out, just under 4%. And then also you're collecting yield on that short call you sell. And then as you get closer to expiration over the next 28 days, you can roll or adjust that short call doing that on a weekly or on a monthly basis. They don't have weekly options, but on a month-by-month basis, collecting credits, that's going to increase your potential profitability also.
All right, turning Darden into an income play.
Yeah.
Right?
Yes.
Buy the shares, generate some income, and also get the dividend.
Yep.
So, all right, turning options into a juicier dividend.
Yep.
Okay, thank you for the trade, Tom White. No thank you for the Mexican food take. Big difference.